So, have you ever actually stopped and wondered what would happen to your personal savings or, even your family home if your small business was suddenly hit with a massive lawsuit or some huge unexpected debt? Or, hey, maybe you're already out there making money, but when tax season rolls around, you feel like you're handing way too much over to the IRS in self-employment taxes. Well, let's dive right into this because choosing the proper business structure is absolutely crucial. It's the ultimate shield for your personal life, and honestly, one of the very best tools you have for keeping more of your hard-earned money. In today's explainer, we're going to break down two of the absolute most popular options out there, the LLC and the S Corp. Welcome to Business Basics Hub. I am so thrilled you're here to build your business foundation the right way. Now, before we really jump in, here's our standard intro disclaimer. This explainer is for general educational purposes only. It's not legal, tax, or financial advice. Laws do vary by state, so always consult a professional for your own specific situation. All right, here's our quick roadmap for today. We'll start with some simple definitions, weigh the pros and cons, walk through a really clear step-by-step formation guide, and finally, look at the biggest beginner mistakes you absolutely need to avoid. Okay, let's kick things off with Section 1, Simple Definitions. Let's clear up exactly what these two concepts actually mean. First up is the LLC, which stands for Limited Liability Company. I want you to picture an LLC as a giant, invisible legal wall built right down the middle of your life. On one side of that wall is your business, and on the other side, that's all your personal stuff, your house, your car, your personal checking accounts. Now, if the business side ever gets sued or, heaven forbid, goes bankrupt, that wall stops creditors from crossing over and touching your personal property. That is the limited liability part of the name. And the absolute beauty of an LLC is its simplicity. By default, the IRS doesn't actually tax the LLC itself. Instead, the profits just pass directly through that wall and right onto your personal tax return. We call this pass-through taxation. And trust me, it makes your life at tax time so much easier. Now, here's where things get really interesting. The S Corp. A lot of folks out there think an S Corp is a completely different, totally separate type of business from an LLC. Kind of like, upgrading from a sedan to a pickup truck. But actually, scratch that. It's not true. An S Corp is simply a special tax election. It's a status that you ask the IRS to apply to your already existing LLC. So, if your LLC is that protective wall we just talked about, think of the S Corp as a special filter you place right on top of that wall. It filters exactly how the money flows through to you. Specifically, it can filter out a pretty good chunk of the self-employment taxes you'd normally be stuck paying. In fact, it was literally created by Congress way back in 1958, specifically to give small businesses a break. Moving right along to Section 2, Pros and Cons Compared. Let's see how these two options stack up side by side. Looking at the left side of your screen, the LLC is the undisputed winner when it comes to simplicity and flexibility. There are absolutely no limits on who can own an LLC or how many owners it can have. Plus, you don't have to deal with the headache of holding formal board meetings or typing up complex corporate minutes. It's purpose-built for everyday small business owners. But on the flip side, over on the right, the S Corp is much stricter. It comes with some pretty rigid IRS rules. For example, an S Corp maxes out at 100 owners, and every single one of them has to be a U.S. citizen or resident. You're also only allowed to have one class of stock. And listen, if you break these rules, boom, you instantly lose your S Corp status. So it's definitely the more complex route to take. And that brings us to the biggest trade-off of all, taxes and payroll. With a standard LLC, all the profit you make is fully subject to self-employment taxes. We're talking about a 15.3% tax just for Social Security and Medicare. If your business is pulling in a lot of money, that hurts. But with an S Corp, you can actually save money here. The catch? You have to officially become an employee of your own business. You must set up a formal payroll system and pay yourself a reasonable salary. And here's the magic trick. Only that specific salary gets hit with the 15.3% tax. Any profit left over in the business after that can be taken as a distribution, which is entirely free from that self-employment tax. So yes, the S Corp definitely requires more paperwork and some monthly payroll fees, but for highly profitable businesses, the tax savings can be massive. All right, let's jump into Section 3, Step-by-Step Formation. Here is your unified 10-step journey to getting everything set up. For Step 1, you've got to lock in a unique name and pick your state. Honestly, for almost everyone watching this, just form it in your home state to keep life simple and avoid paying double fees. Step 2, appoint a registered agent. This is just a person or professional service that has a physical address in your state and is available during normal business hours to accept legal documents. Do not skip this. Then step 3 is where it gets real. You file your articles of organization with your state and pay the filing fee. Once the state accepts it, congratulations, your legal wall is officially built. But we aren't quite done yet. Step 4, draft an operating agreement. This is basically your private internal rulebook. Even if you're a solopreneur and the only owner, you still need this document to prove to courts and banks that your business is a legitimate setup. And finally, for this page, step 5. Head over to the IRS website and grab a free EIN. That's a federal tax ID number. Think of it like a social security number, but for your business. Moving right along to step 6, go open a completely separate business bank account using that shiny new EIN. Step 7, check in with your city and state to secure any necessary local business licenses. Now, if you're planning to stop at just an LLC, you can actually skip right ahead to step 10. But if you want that sweet S-Corp tax filter, you really need to pay attention to steps 8 and 9. For step 8, you must set up a formal payroll system, because remember, you're about to become an employee. Step 9, you file IRS Form 2553. This is your official request for S-Corp status, and the deadline here is absolutely critical. You only have 75 days from the start of your tax year to get this filed. And finally, step 10, which applies to everybody, maintain your ongoing state annual reports. That's how you keep your protective walls strong year after year. So that whole process sounds fairly straightforward, right? Well, the reality is that business owners trip up on this stuff all the time. Which naturally brings up a pretty critical question. What are the biggest mistakes new owners make that can completely ruin their liability protection, or worse, trigger an IRS audit? That takes us to Section 4, Beginner Mistakes. Let's look at the most dangerous pitfalls you need to avoid right from day one. Without a doubt, the number one absolute biggest rookie mistake is mixing your personal and business money. If you take your LLC debit card to buy your personal groceries, or you deposit a check meant for the business directly into your personal checking account, you are doing something called commingling funds. And if you get sued, a judge is going to look at that and say, well, you didn't treat this like a real separate business, so you don't get the protective wall. They will do what's called piercing the corporate veil. And suddenly, your personal savings are entirely on the line. Mistake number 2 is simply forgetting those annual state reports we talked about, which can literally cause your state to shut your business down entirely. Mistake 3 is messing up the S-Corp salary. We'll dive into that in just a second. And mistake 4 is letting your registered agent go dark. If you're sued and the court can't deliver the paperwork to your agent, you can actually lose the lawsuit automatically by default. No one wants that. I want to pause on that S-Corp salary mistake for a moment because it is incredibly common. There's this huge myth floating around the internet that if you have an S-Corp, you should just pay yourself 60% of your profits as a salary and take the other 40% as a tax-free distribution. Well, look at this quote right from our source material. There is no universal 60-40 rule, period. The IRS watches owner compensation like a hawk. You have to pay yourself what they call a reasonable salary, and that means exactly what it would cost to hire someone else right off the street to do your exact job. If the IRS thinks you're paying yourself an artificially low salary just to dodge those self-employment taxes, they will come after you with back taxes, massive penalties, and interest. So please, do your research, find real salary data for your specific industry, and document exactly why you chose your salary number. And finally, Section 5, Final Thoughts. Let's wrap this all up. Thanks so much for watching this explainer. If you found this breakdown helpful at all, please subscribe to the channel and hit that notification bell so you don't miss out when new content drops. Do me a huge favor and leave a like, and definitely feel free to share this with a fellow entrepreneur or anyone who could use a little extra business clarity. Building a business is really tough, but you absolutely do not have to do it alone. Finally, just a quick reminder with our standard outro disclaimer. This content is for general educational purposes only and is not legal, tax, or financial advice. Laws and requirements really do vary by state and individual situation, so please consider consulting a qualified professional for guidance specific to your own business. The most important thing here is that you actually take that first step. Build that legal wall and protect your future today, which leaves me with one final question for you. Are you currently overpaying the IRS right now without even knowing it? Think about it. Until next time, keep building.